You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello and welcome to OIC's Wide World of Options. My name is Mark Benzaquen, and joining me today is 25-year option veteran, former floor trader, and one of my partners here at OIC, Ken Keating. Thanks for joining me today, Ken.
Well, thanks for having me, Mark. I'm happy to be here.
Ken, things have been pretty crazy on Wall Street recently, and not just in the market overall, but with several of the big name, high profile single stocks releasing earnings reports and making some pretty big swings in the share prices. For our time today, I'd like to talk about earnings, what they are, why they're so important, and what opportunities and what risks trading earnings pose for option traders. So let's start with what they are and why they're so important. Ken, give us a bird's eye overview of earnings, if you would, please.
Okay, so earnings are important because they are reported every quarter. So every company has earnings that they're reporting 4 times a year. And they're very important because they can derive the value of any stock up or down based on what Wall Street or the analysts are predicting. So in the case of analysts, so analysts analyze a company's earnings. They're going through spreadsheets all day, trying to monitor a company's potential revenues, its costs, its sales. So earnings are simply what's left over from revenues after costs are taken out. So it's the profit after they're paying their expenses. And why it's important is because these analysts come up with earnings estimates. And when the company reports, they're either going to beat the estimate or miss the estimate or come in right at the estimate. Now, there's also something that's important, which is called a whisper number. So a whisper number is the unofficial estimate of a company's earnings. And this is usually done by Wall Street traders and other participants in the market. And oftentimes there'll be an analyst expected number, and then there'll be a whisper number. So a lot of Wall Street looks at that whisper number. Typically, that whisper number will be higher in terms of actual earnings or revenues. But so a lot of traders will look at the whisper number rather than actual analyst expectations. But they incorporate both into their analysis as well.
Is that whisper number, Ken, is that what we refer to as the street estimate, beating the street, for example? Is that what you mean by the whisper number?
Well, the street is actually analysts, but the street is also the unofficial whisper number in and of itself. So, like I said, there's two earnings numbers. So the earnings estimates, the analyst estimates, are different from the unofficial whisper number. And oftentimes the whisper number is associated with the street estimate. So when a company beats the street, typically they would be talking about this whisper number that is different than, might be a little higher than the actual analyst expectations as well.
Okay, so speaking of those expectations, if a company misses the expectations or if they beat the street, those are going to be polar opposites, right? And assuming that a company either misses their expectations or they beat the street, if either of those situations happen, we might expect some pretty turbulent and volatile trading for the short term, right?
That is correct. That is correct. So oftentimes, companies, obviously, investors are looking for companies to beat their revenue guidance, beat their earnings guidance, but sometimes they'll beat on what's called the top line and the bottom line. So the top line is what's considered revenues, and the bottom line is the actual earnings after they pay out their expenses. So sometimes they can miss on the top line, but beat on the bottom line, and the stock will move. And also, there are times when they beat on both the top and the bottom line. Sometimes they miss entirely. They'll miss on the top line and the bottom line. So depending on that combination of earnings and what Wall Street is expecting, will certainly drive the stock either up or down which could be a very significant way.
Right, and that's where we get all of that volatility that we've been seeing in the market lately. These companies either missing those expectations or beating the street, and we've seen very, very volatile stock trading and therefore options trading as well. And let's keep that. Let's keep that perspective from the options trader for a second. So in the days or weeks leading up to an earnings announcement, the market, as you had mentioned, has a certain expectation of what those earning results may be. And that goes hand in hand with something that you and I like to discuss a lot, options volatility and implied volatility specifically. So let's look at it from this earnings perspective. We've got a couple weeks to go until a company announces their earning or releases that earnings report. What can you tell me about those expectations and how they're reflected in the price of an option?
Sure. So once again, options are forward-looking vehicles. So they're trying to anticipate how volatile stock will be between now and its expiration. So into an earnings event, which is a binary event that happens 4 times a year, it's very likely that the implied volatility or the expected move for a particular security may go up leading into an earnings event. So implied volatility is, I always tell people, is it's the most misunderstood but crucial aspect of trading options. And when you hear people on TV talk about implied volatility, all they're really talking about is the actual level of options prices. So in other words, when implied volatility is high, that equates to higher option prices. And when implied volatility is low, that equates to lower options prices. So typically going into an earnings event, which is an unknown number, this actual earnings number, traders are trying to position themselves and trying to forecast how much that stock will move between now and that earnings expiration. So Typically, implied volatility or option prices will rise into earnings, but it's not always the case. Sometimes implied volatility will rise into the expected the earnings announcement, and then maybe a few days before tail off if it gets too high. So it's a very fluid situation, but typically implied volatility does tend to go up into an earnings event.
Okay, so now let's stay on that timeline. So we're going into the earnings event, and let's look at two scenarios. One in which the company misses those street estimates that we talked about, and another in which they beat the street. So let's start out with earnings and a company that misses those estimates. What might we see that next day when it comes to options pricing?
So in that case, when let's just say a company misses the street estimate, so they completely disappointed the street. The street was expecting a number that ended up being a lot lower than what they were expecting. In that case, maybe let's say the options market was pricing in a 5% move, either up or down for the earnings announcement. And if they miss in a big way, it's very possible that that stock might move 10%. It might go down by 10%. If they really miss their earnings estimates, we would expect the stock to go down. And typically, after the event, when the news is out, implied volatilities typically go lower because what was once an unknown event now is known. But if the stock goes down enough, it's very possible that the implied volatility could actually go up. And I've seen this happen in many instances where the implied volatility does go up even higher after the earnings are announced. So, this vol crush or volatility crush that everybody talks about, well, typically that's what happens after an event. But if the stock makes a parabolic move either way, it's very possible that implied volatility might not come in as much as you expect. So, and that's if the stock makes a bigger move than was expected in the marketplace.
Right. And implied volatility, as everybody knows or should know, is a statistical representation of standard deviation. And in statistics, there's this concept called revert to the mean or mean reversion. And with implied volatility, as Ken, as you had explained, it typically gets increased as we go into earnings. Once that unknown becomes known, there's this concept that the implied volatility reverts back to the mean where it was prior to this earnings. But Ken, what you're saying is if the stock or if the company misses those earnings expectations and misses them in a big way, then we can actually see increasing levels of implied volatility because of those disappointing earnings as opposed to what we might expect. And I know a lot of beginning traders have this concept that implied volatility is going to revert back to the mean. What you're saying is that may not be the case, even if a company misses earnings. Is that right?
Right. So in the case of a company missing earnings, once again, if it misses, Wall Street was expecting a 5% move and they miss their numbers completely and the stock goes down 10%, there's going to be a lot of uncertainty surrounding that stock in people's minds and investors' minds saying, well, if they miss their earnings this bad, what does that mean going forward? So, and because of that, you might see implied volatility actually go higher. So on the upside, if a stock beats its earnings estimate, let's just say the market was pricing in a 5% move and the stock makes a 10% move to the upside. In that case, you very well would see a implied volatility crush. The implied volatility would revert back to its historic mean or where it was trading before the earnings announcement. And in that case, typically you would see a volatility decrease, even though the stock made a move that was greater than what was expected by the market.
Mm-hmm. And this is where, especially for beginning traders, this is where the picture, the pricing picture gets kind of blurry because as we've learned, especially looking at call options, for example, if the stock price decreases, then call option prices decrease. However, if the implied volatility is increasing because of maybe this drastic move in share prices going lower, implied volatility is going to increase, which is then going to raise option prices. So it's kind of a balance or a dance that investors need to be aware of, that just because one thing is happening, in this case, a significant decline in stock prices, that doesn't always translate into decreasing option prices as well. If the implied volatility increases because of a significant move, as you had mentioned, with the stock, it's tricky to predict what is going to happen with option prices. And then, Ken, you had mentioned if the company does the opposite, if they beat expectations significantly, we might see a high or a parabolic, as you had mentioned, increase in the price of the stock. But at the same time, we might see a decline, that IV crush that you were referring to, that is going to decrease option prices. So, in some instances, the two pricing inputs, in this case, share price and implied volatility, sometimes they work hand in hand, sometimes they work against each other. So, definitely, an interesting dynamic that earnings season presents to option traders, and often a tremendous amount of opportunity to profit, but also in many, many cases, a tremendous amount of risk. So with that in mind, Ken, let's go to our next point here. With these opportunities, and let's look at it from an opportunity standpoint first, what are some different strategies that an investor can use? I'm assuming this is where straddles and strangles come into play. Is that right?
That's correct. So if the market, let's just say earnings are being announced in a couple days, and typically when traders are trying to anticipate how much a stock will move either up or down, they're really going to be looking at the near-term straddle price. So let's just say a stock's trading 50. They're going to look, and we have options that are expiring in a week. We're going to look at that 50 straddle because it's really going to be giving us an idea of what the market is expecting in the near term. So let's just say that 50 straddle, the calls are trading for 250 and the puts are trading for 250. So the market is essentially expecting a $5 move in either direction or a 10% move in either direction for this earnings announcement. So now if an investor thinks that stock is going to meet or miss their earnings expectations in a big way, they might be thinking that the stock is going to move 15% or maybe 20%. So in that case, if you think that the stock is going to make a bigger move than what's being expected by the market, then you might incorporate a long straddle or a long strangle. So a straddle is when you buy a call and a put that share the same strike in the same month, in this case, the 50 straddle, or you might buy a strangle, which is you're buying an out-of-the-money call plus an out-of-the-money put. So maybe you buy the 55 call and the 45 put. So now you need an even bigger move outside 45 and 55 to profit, but you're also going to pay less for that. So obviously the at-the-money straddle is always going to be the most expensive because it's all time premium. It's 100% time premium. Where a strangle, it's still all 100% time premium, but now you're using wider strikes, but you do need a bigger move.
Mm-hmm. Now, and then the flip side to that, if you didn't think that the market was going to make as big of a move as expected, then you might sell the straddle or strangle, correct?
Correct. But also keep in mind that anytime you sell options, you have a lot of risk. So obviously, the worst case scenario on the downside, a stock could go to zero. And the worst case scenario on the upside is theoretically the stock has unlimited upside. So, in theory, a stock could go to infinity. Now, I've never seen a stock go to infinity, but I've been on the wrong side of a trade that felt like it was going to infinity, and it's no fun. But that being said, anytime you sell options and you're net short contracts, you do have a considerable amount of risk. So some way to mitigate against that, traders might incorporate spreads. They might incorporate what is known as a butterfly or an iron condor. These are strategies that will allow you to sell high implied volatility while limiting your risk. You might also do credit spreads where you sell the higher strike. In the case of a call, you sell you sell one strike and you buy a higher strike against it, or you sell a bull put spread where you sell a strike and then you buy a lower strike against it. So in this case, you're taking in premium, you're collecting a credit to do so with a credit spread. That's why it's called a credit spread. And you're defining your risk. You're essentially in a credit spread. Let's just say you sold the 50-55 call spread for $2. Well, you're going to take in $2. That's yours to keep, but that's the most you can make on this position. The most you can lose is the difference in strike, in this case, $5, less the credit that you took in. So 5 minus 2 is 3. So you're risking basically $3 to make $2 in that case. But you've defined your risk. If the stock goes to 80 from 50, you're going to lose that $3, but that's the most you're going to lose on that position. So there are ways you can structure options, and this is the beauty of options, that you can tailor them to your forecast and motivation, and literally you can make money if the stock is going down, if it's going up, or just staying quiet and kind of moving around a certain price. So everybody has their own risk tolerances and forecasts on a particular stock, and this is the beauty of the market. That's why there's a two-sided market for the stock and the options. So, but once again, there are a lot of creative ways that you can structure a position that allows you to sell high implied volatility while mitigating your risk.
Right, and you had mentioned the flexibility of options. One of the reasons that we certainly here at OIC and investors around the world love options so much is that flexibility. You can tailor a strategy to your market outlook, to your risk tolerances as well. And sticking with the risk tolerances, let's look at the earnings strategies from a different standpoint, not from an opportunity to profit standpoint, but let's look at the opposite, risk mitigation. One of my favorite things about options is that they can be employed specifically to mitigate any risk. And here with the earnings season, with earnings announcements, we don't really know what's going to happen. Sure, the street has expectations. The investor may have expectations. But if those expectations aren't met, the investor can face a pretty terrific or a significant amount of risk. So when it comes to earnings season, what strategies can an investor use to protect themselves from these parabolic moves that a stock might make? The first two that come to mind would be a protective put and paying for that put in the form of a collar. Are those two strategies that might help an investor protect themselves from these unknown earnings announcements?
Absolutely. So in the case of a protective put, you own stock and you're going to buy a put to protect against a big loss to the downside. Now, granted, if the implied volatility for the options is high going to earnings, which typically it is, that put is going to be expensive in terms of implied volatility. So in the case of a put, if you own the put and you own stock, you still have unlimited upside because you participate on the upside with your stock, but you just need the stock to make a greater move than what the put was implying. So on the downside, you are once again protected. So if the stock makes a parabolic move to the downside, you're protected by that put. And keep in mind, you don't necessarily have to exercise that put to take advantage of it. So let's just say you've owned a stock for a long time and you don't want to sell it, but you buy a protective put against it. So in this case, the stock goes down in a big way and you still own the stock. So you're going to lose money on the stock, but you're capped out on the downside by purchasing this put. You could actually sell that put into the open marketplace, take your profit that way. And, you've cushioned your loss on the stock. Maybe you take the proceeds from that put profit and buy additional shares or anything else. But, once again, you don't necessarily have to exercise that put to close the position. You can sell it out in the open market and take your profit that way. So in the case of a collar, sometimes, once again, those puts are going to be very expensive going into earnings. So some traders might put on a collar, where a collar is the purchase of an out-of-the-money put with the sale of an out-of-the-money call. That out-of-the-money call is going to lessen the cost of that protective put. So you basically are going to cap your upside while protecting yourself to the downside. But you're only going to do this if you are near-term, kind of neutral to bearish on the shares, or maybe moderately bullish, but you don't really want the stock to make a big move because by selling that call, big move to the upside, because by selling that call, you've capped your upside. So once again, a caller only works for somebody who's really thinking that, okay, I think the stock is going to make a big move to the downside, but I don't want to sell my stock. I'm just going to protect it. So in this case, protective puts or using a collar where you're selling that call to offset the value of the cost of that put to lower the cost of your hedge might be something you would consider.
Mm-hmm. Well, Ken, thank you so much. Unfortunately, it looks like we're running out of time. So, Ken, I do want to thank you for your time today. Thank you for joining me. Fantastic information. And ladies and gentlemen, before we sign off, I just want to invite our listeners to send us your questions to be featured in a future segment of OIC's Wide World of Options. You can contact us via email at options@theocc.com, or you can live chat with us on our website, optionseducation.org. And while we'll respond to your questions directly, we might also share your question with our listeners in a future podcast. So thanks again to all those listening. Ken, thank you so much for joining us. We'll be talking with all of you again very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.